Here's something nobody tells you about recessions. They're when I make my best returns. Not during them exactly, but because how I position before and during the downturn. Today, I'm walking you through exactly how I deploy $1 million right now if I knew a recession was coming. The specific sectors, ETFs, stocks, the percentages, and why this boring sounding portfolio has historically crushed it when everyone else is panicking. This isn't about getting rich quick. It's about staying rich when markets turn ugly. I've lived through two major downturns. Graduated from university during the 2008 financial crisis, which nearly broke me, and COVID, which I actually managed pretty well. And here's what I learned the hard way. Recessions aren't about making money during the crash. They're about not panicking when things get bad and then having the capital ready when everything goes on sale. What if I had to build a completely hands-off, set it and forget it recession portfolio with $1 million? Not everyone wants to manage trades from a hotel room in Lisbon or a beach town in Mexico. Sometimes you just want something boring and defensive that works while you're living your life. So, the hypothetical strategy I'm sharing today is designed around one simple idea: protect first, profit second. Because here's the thing, if you lose 50% of your money, you need 100% gain just to get back to even. The math is brutal. So let's build something that zigs when the market zags and then pivots hard when the opportunity shows up. First, 10% in cash or cash equivalents, specifically $100,000 sitting in treasury bills or an ETF like SGOV, which holds short-term government bonds. Now, I know what you're thinking. Cash in a recession? Isn't that just losing to inflation? And yeah, normally you'd be right. But here's why I keep 10% liquid. Opportunity cost. When everything's melting down and people are panic selling great companies, during the COVID crash in March 2020, I had about $100,000 in cash, and I used $70,000 of it to buy stocks and leaps at a 30 to 50% discount. Those purchases alone returned over 80% in the next 18 months. That's the value of liquidity when everyone else is tapped out. T-bills are currently paying around 3.5% anyway, which isn't amazing, but it's not nothing. And SGOV is this basically same thing wrapped in an ETF you could buy and sell like a stock. No drama, no risk, just boring safety and dry powder for when things get interesting. 20% in consumer staples, or $200,000. Here's where we start getting defensive. Consumer staples are companies that make stuff people buy no matter what. Toothpaste, cereal, toilet paper, beer. Recession or not, you're still brushing your teeth. I put $200,000 in either Vanguard's BDC or State Street's XLP. Both are solid ETFs that hold companies like Procter & Gamble, Coca-Cola, Costco, and Walmart. Why 20%? Because I learned this lesson the hard way. In 2009, I was watching my stocks crater. Everything bleeding red, losing 40, 50%, sometimes worse. But my small position in Procter & Gamble, it just sat there, barely moved, and kept paying me dividends every quarter like nothing was happening. That's taught me something critical. Volatility kills more portfolios than actual losses do. When you're watching your net worth swing wildly every day, you panic and sell at the bottom. Staples smooth that out. They have pricing power, steady demand, and dividends that keep coming even when everything else dries up. Another $200,000 goes into healthcare through Vanguard's VHT or State Street's XLB. These hold pharmaceutical companies, medical device makers, hospitals, and healthcare services. The logic is brutally simple. People don't stop getting sick during recessions. If anything, stress makes health problems worse. You might delay buying a new car, but you're not delaying your cancer treatment or your kid's insulin. During the 2008 crash, healthcare dropped about 25%, while the broader market fell 50%. Still painful, but survivable. These companies typically carry huge cash reserves and strong balance sheets, so they're not going bankrupt, even if things get really bad. Plus, demographic trends are on your side. We've got an aging population in most developed countries, which means more healthcare basically forever. Utilities get $50,000. It can be split between Vanguard's VPU or State Street's XLU. These are your electric companies, water providers, natural gas distributors, the absolute necessities. I keep this allocation at 5% because utilities are super defensive, but also super slow growing. Even during the Great Depression, most utility companies kept paying dividends. People can lose their jobs, default on mortgages, stop eating out, but they're not turning off their electricity. These companies often have monopolies or near monopolies in their regions with regulated, guaranteed returns. I put $100,000 into discount retailers. You can do this via an ETF like XRT or individual stocks like Dollar General, Walmart, and Costco. Discount retailers often do well during recessions. When people lose their jobs or get scared about money, they trade down. They stop shopping at Whole Foods and start shopping at Walmart. During the 2008 recession, Dollar General's stock actually went up about 20%, while the market collapsed. Walmart barely dropped. People called it the lipstick effect. When consumers can't afford big luxuries, they buy small ones at discount stores. I put about $50,000 into GLD, the Spider Gold ETF. Not because I think the dollar is collapsing or because I'm betting on Armageddon, but because gold is uncorrelated with stocks and tends to hold value. When during COVID's initial panic, gold jumped 25% in a few months while everything else was bleeding. Here's where we pivot from defense to offense. The biggest chunk, $300,000, goes into growth stocks like ETFs, QQQ, XLK, or VOO, which tracks the S&P 500. Why am I putting 30% into growth stocks if a recession is coming? Because recessions don't last forever. And the absolute best time to buy growth stocks is when they're on sale. The key is having that defensive 70% staying relatively stable, which lets you hold these growth positions, or even buy more without losing sleep when they inevitably drop. The allocation I just described is your recession stance. Defensive, boring, protected. But you can't stay that way forever. Here's how I think about rebalancing. When the market has dropped 20% from its peak and stays there for a couple months, I start shifting. I take 5% out of cash, 5% out of staples, and move that 10% into growth. When we're down 30%, I move another 10%. Down 40%, I'm moving another 10%. Basically, I'm using the defensive positions as a piggy bank to buy growth stocks on sale. It's simple dollar cost averaging into the paint. This is incredibly hard psychologically. You're buying when headlines scream doom, but it's how wealth is built. Coming out of recession, usually 6 to 12 months after the market bottom, I'd start rebalancing back. I'd trim the growth positions that have recovered and rebuild cash and defensive holdings. It's boring, it's mechanical, it works. During COVID, tech stocks in the NASDAQ fell about 30% in a month. Terrifying. But if you had the nerve to hold or the cash to buy more, this portion would have given you returns of 70, 80, even 100% in some cases over the next 2 years. This is the part that generates wealth. The other 70% preserves it. I'm in Mexico City right now with no idea what I'll be doing 3 months from now. Maybe I'll be in London, maybe Japan, maybe back in the States visiting family. That freedom, that work optional life, only works because my portfolio is built to survive the bad times, not just celebrate the good ones. Now, this hypothetical $1 million allocation isn't my only strategy. I run the wheel, I trade options, I do plenty of active stuff. But here's the thing, when things get uncertain, it's nice to know I could flip to something like this. It's nice to know I could flip to something this simple and defensive if I needed to. This isn't sexy. It won't make you feel like a genius stock picker. But you know what? You'll sleep at night. You'll have capital when opportunities show up. And you'll actually stay wealthy instead of just getting wealthy once, then giving it all back. The biggest lesson from living through multiple recessions isn't about which stocks to buy or which strategies to run. It's about having options, knowing you can build a portfolio that serves your life. Boring works when you need it to. Diversification works. Having a plan you can fall back on works. If a recession is coming, and eventually one always is, don't just rely on being clever or quick. Have something defensive and opportunistic enough to thrive. Then go live your life and let at least a part of your portfolio do its job on autopilot. That's it for today. If this was helpful, hit the like button. If you want more real talk about money, fire, and building a life that doesn't depend on a job, subscribe. And drop a comment telling me what your recession strategy is. I want to read these and learn from you all.